So I wanted to go over an example that we have here in slide 17. We have a transaction analysis illustrated. Let's prepare some journal entries and post them to the ledger. So we have on January 1, stockholders invested 2,000 in the company. So we have here a 2,000 debit and a $2,000 credit. And as I said before, notice how it's not relieving the system. The fact that we received funds actually is going to help us, or is causing us to have cash. And what we spend that cash on is not really, we don't know it immediately, but this is definitely cash, increasing the cash of the company. On January 15, the company borrowed 6,000 from the bank. So again, we borrowed, so that means we are receiving a cash from the bank, and there's a loan payable, which is a credit. It's a liability. So notice that we have a situation where when we receive an asset, we have a liability or an equity on the other side. So notice that is keeping the accounting equation intact of assets equals liabilities plus equity. Somebody in the live class asked, I don't get it, why is assets minus liabilities equals equities? I don't get why assets equals liabilities plus equity. And actually it took me a minute to think about it, but I mean, if you look at it, what I ended up thinking about is like, hey, if you borrow money, say you went out and you bought a bunch of stuff on your credit card, you borrowed stuff, but now you have clothes, or now you have a new appliance. You're gonna have an asset on the left side of that equation because you had a liability on the right side of that equation. I think a lot of times we think of liabilities as like, oh, that money is gone. It's not gone. You borrowed funds to get an asset. We didn't waste those funds. And it's like in the personal sense of things, we don't do accounting on our asset side, so we don't look at what we end up getting for that liability. But that liability always incurs an asset. What we spend that asset subsequently could be an expense, and we'll get into that on the next one. So on February 1, equipment costing 10,000 was purchased for 2,000 cash and a note for 8,000. So we have an equipment of 10,000. We put an asset on the books for 10,000 and we spend 2,000 in cash. So that reduces the cash balance, and now we have a liability for 8,000 as well. So it shows you this interplay. The next one is on February, equipment that cost 3,000 was sold for 3,000. The 3,000 receipt will be 30 days. So we're taking equipment off the book, so that was a debit originally. So to take it off, we need to have it be a credit. And we're expecting 3,000 as an accounts receivable over the next 30 days. So it's something that's coming in the future. So that is an asset, but we call it accounts receivable rather than cash. On February 20th, company provided services for 8,000 and received cash. So we received cash, and that's basically sales. We can call it service, like which product service, but it's basically called sales still because you sold something and you received cash. So that will reflect on the balance sheet. And if you think about it, sales, as the equation said in the previous beginning of the chapter, sales will end up being on the right side of your equation because assets equals liabilities plus equity. Equity will include sales less expenses because at the end of the year, income goes into equity. So that's why why is sales credit? It's because it's on the right side of the equation rather than the left side of the equation. Wages of 2,000 were paid in cash, so all expenses are a debit. So that's going to be a debit because cash leaves, that's a credit. Sometimes you can figure out one side of the debit credit if you know the other. So if you know, hey, it's cash is leaving because I paid something. Oh, okay, that's a credit. Then I know expenses must be a debit. So this is a summary of an example of how to work with journal entries.